Welcome to the Investment Conversation. I'm Andy D'Souza, Chief Marketing Officer here at Lord Abbett. We've seen a lot of volatility recently in the news, a couple of major themes, geopolitics, and the disruption in technology. To help unpack what's really going on, I'm joined by Matt DeCicco, Director of Equities.
Thanks for having me.
Thanks for coming on again. And Rob Lee, our co-head of Taxable Fixed Income. What's going on, Rob?
Doing great. Great to be here.
All right, great to have you guys. Let's get right into it. So, two things you laid out in the beginning here between geopolitics and disruption in technology. Why don't we start with you, Rob, and let's talk about geopolitics. What's happening here?
Sure. Okay. At the risk of stating the obvious, the thing in all the media for good reason is the U.S. and Israeli strike on Iran. The reason that matters is energy. The Middle East is energy rich. This is oil and natural gas. Some economists would argue, with pretty good reason, that the economy is energy transformed. High prices at the pump, high natural gas prices matter for everything. Households, you go to fill up your car at the gas station, you turn on your stove, it's warmer now here in the Northeast, but when it's cold in the winter, many people heat their uh, homes with hydrocarbons. The same is true for businesses, and energy matters for everything. There is a broader geopolitical risk element too. When missiles, bombs, and drones are flying, usually you get some risk premium priced into markets. So the big issue and the risk is with higher oil prices and natural gas prices, especially European natural gas. When those things rise, you have an effect on the economy. And more specifically, I would say wars tend to be inflationary, and wars in commodity, especially energy-rich regions, which is true today, tend to impart stagflationary impulses. It doesn't mean you guarantee you get stagflation, but the impulses are there. If you're spending a lot and filling up your car so you can drive to work or on vacation or to the grocery store, you have less to spend on groceries or clothes or anywhere. So that will impinge on the household balance sheet and, you know, and disposable income. That's the big issue. The last thing I'd say on this, and there's a lot to talk about,
Hmm.
but the last thing I'd say right now is how high oil prices get, or energy prices more broadly, and how long they stay there is the key for determining how big those stagflationary impulses are.
And I guess over time, how independent or not are we as a country from foreign oil versus previous times? And you mentioned Europe as well. What's the difference or similarities there?
Okay, so the U.S. is in much better. The good news is the U.S. is in much better shape than other parts of the developed world, as a blanket statement. The U.S. had and has and continues to benefit from the shale revolution. We are net oil exporters, and I believe we're net natural gas exporters through LNG, liquefied natural gas. The shale revolution changed the geopolitical power on the energy front for the U.S. The U.S. has a lot of resources in general, given the size geographically and the resource-rich nature. It's not just energy, it's agriculture and things like that, which are being affected by the energy and oil crisis now. Um, but the U.S. is in much better shape. So that's the first. Europe is not. Europe gets a lot of its energy, natural gas in particular, it used to get a lot from Russia, but after the invasion of Ukraine 4+ years ago, that's mostly or essentially shut off. So most of Europe is very dependent on the Middle East. The same thing is true for Asia, in particular China, Japan, South Korea, three of the biggest, Asian countries, in, economically speaking. They're large. Same thing with India, large importers of energy, and a lot of it comes from the Middle East. Right now, the Strait of Hormuz is effectively shut. There's a few ships going, tankers going through, but essentially shut.
And about a fifth of the world's goes through there. Is that right?
Yes, both oil and natural gas, to my understanding. I've seen some slightly higher numbers, but that's ballpark. I've seen 20% to 30%, so it
Hmm.
depends on your source.
Okay, great. And look, headlines are moving fast. Today is actually March 11th, just for the record, because things do change pretty quickly here in this marketplace. And speaking of things that change fast, Matt, let's turn quickly to the second big headline we're seeing out there, which is disruption in technology. I think there was a paper that came out by Citrina Research recently. It was last month, a couple weeks ago, I think at this point, that was titled "The 2028 Global Intelligence Crisis," and that sort of forecast things like 10% unemployment and other things. Almost, to my understanding, it was almost like AI productivity kind of went. It was almost like too good. Is that right? And what's happening?
Yeah. So I think maybe just take a step back. This is a major platform shift. It's a incredible technological disruption that's now over 3 years old. And during that 3 years, the power of the technology has continued to improve. If you think about what you were using ChatGPT for in late 22 compared to a year and a half ago, where you realized, wow, the research that I can do with this has gotten a lot better, to today, where with things like OpenClaw or Claude Code, you're able to have a full project be done by you by an agent. So the rate of change of the technology is continuing to increase. And so one can extrapolate to infinity and make predictions, I'd say, in both directions. One of a utopian society where there's wonderful productivity gains that accrue to all, or a much more dystopian future where you have, in the article you mentioned, where unemployment is very high. Um, I'm not going to make either, although I will point out that there's a reason that dystopian thrillers sell books and are blockbuster movies, and you don't go watch uh, a utopian movie or read a utopian book. It's human nature to be much more attracted to what can go wrong. So I think there's both sided risks to the pace of technological uh, uh, s- uh, change that's happening with generative AI, but I'd caution against getting overly negative or perhaps getting overly positive. Um, just if we just kind of think about, though, what actually is happening is the pace of productivity as people are using these tools is increasing, and the supply for compute to use these tools is being outstripped by the demand for people using those tools, whether it be people like you or me or Rob, to become more productive in their jobs. I think right now, these tools are providing tremendous value to the work I do every day, and they're providing tremendous value to the work that people do in a lot of different industries. The academic research, and if you just go by anecdotes, you're getting maybe 20-25% productivity from these tools. While I think there's certainly some things to be, uh, you know, concerned about how quickly the technology is moving, I think that we should be looking at, okay, what are the opportunities, what are the risks, and making good investments based upon a balance of the risk and reward.
And what about for either of you here? Because I know it kind of crosses all markets. What about the idea of the actual dollars and cents being invested with saying the hyperscalers investment in this, and what does that mean?
Yeah. So, roughly, I can start on this, Rob, and you could please chime in. Roughly next year, the big five hyperscalers will include Oracle, are projected to spend about $550 billion in CapEx. And that's not all for generative AI tools, but you could think of it as mostly driven, the growth in that is mostly driven by building out data centers or artificial intelligence factories. To put that in context, before ChatGPT, so in 2022, these big five were spending, maybe 150 billion in capex, and it had grown in the year over that year before that by about 15 or 20%. And so now we're talking about, $550 billion in capex in 2026, and the growth in 2025 was north of 65%, and is probably going to grow, significantly again this year. So higher numbers and higher levels of growth. So it's a significant amount of spend.
But to tie it back to what I said earlier, why are they spending this much? It's because the demand for the compute that spend is enabling is still outstripping supply. So every one of the companies, every one of the hyperscalers is telling you that they're seeing higher revenue growth uh, compared to what they were doing 2 or 3 years ago in their cloud businesses. And they're telling you that their growth would be faster, including you're hearing the same thing from Anthropic or OpenAI if they had more compute. So the amount of spend is very high, and it's much higher than it was in the past. But what is driving it are good fundamentals, which is demand outstripping supply.
Got it. And Rob, I think maybe another question I have on the same lines here uh, would be, how do we measure the return on that investment? Is that even possible this early on?
Yeah. Okay. So let me say one thing before I answer that question.
Sure.
The biggest technology companies, these so-called hyperscalers, these are some of the most profitable, most highly cash flow and free cash flow generating companies, less on the free cash flow side because they're spending so much on AI build out and infrastructure. But these are monsters. These are 1 and 2 and 3+ trillion-dollar market cap companies, massively profitable. So they have the financial wherewithal to make these massive multi-hundred-billion-dollar investments. They could be making a mistake. That is a possibility. But these are not stupid people, at the risk of stating the obvious. They see something, and the something is massive innovation, a very exciting time to be alive. This is the more utopian side. If you're not using these tools, I suggest you do for all our, viewers or listeners. What you will see, I paraphrase an Arthur C. Clarke quote, the old, science fiction writer. Technology sufficiently advanced is indistinguishable from magic. And that's kind of what we saw in November of 2022 when ChatGPT came out. Every month or 2 or 3, sometimes it feels like every week, some new model gets
I think it was yesterday. Another
developed,
say, yeah.
and then released.
Hmm.
And every single one, I don't want to exaggerate, but especially for the best AI labs, the advancement, the innovation, the progress is astounding. I don't think is an unfair word. So if you're not using these tools at whatever level, you should be, just to see how it's going. And if you did it 3 months ago and you stopped, you probably want to try it again because something else happened and you're going to be dazzled probably. That's what they see, these hyperscalers. It seems unlikely, I can tell a more dire scenario and a counterpoint, but it seems unlikely they're going to stop anytime soon. So that's the big picture. As long as the innovation and progress is there, they're going to keep going. The opportunity set, by the way, for those hyperscalers is massive, because if you win and you build the best machine, the best LLM, the best model, AI model, the so-called TAM, the total addressable market, is, I'll say, gigantic. For effect, sometimes I say it's the world, or on a bad day or weak day, I say the universe. But it's massive is the so there's both offense, where they see an opportunity to capture huge market share, extension of their businesses, additional revenue. On the opposite side, and I'm kind of more in Matt's territory here, so he can refute or confirm. On the opposite side, if you don't do it, maybe you're going to be a dinosaur in
Sure.
1, 3, 5, 10 years. If you fall behind, I don't think they're going to stop. So that's the first. To size it a little bit, and you asked Matt this, you're talking about 500, 600 billion. It keeps going up, and every year in the last few years, it goes up, and it keeps surprising on the high side. The one way to put it into context is, there are a few ways. The U.S. economy in nominal terms is around 30 trillion. So half a trillion is small relative to 30 trillion, but it's not small in an absolute sense, and it's not small in a growth investment sense. I mean, those dollars had to go somewhere. Sometimes they
Yeah.
are retained as earnings by the companies, and sometimes they get paid out to shareholders in different ways. But now it's going to cutbacks.
Yeah, and again, just the idea of the measurement of the return on that of the overall investment they're making. Matt, any comments on that?
Yeah, I would go back to, and I I would go back to what I ran through some of the numbers before. The increase in revenue growth for GCP, for example, Google's cloud business, from low 30s to 50%. And 55% of that margin, 55% of that revenue is coming down, is dropping down to the bottom line, incremental margin. So and these are huge businesses. AWS is a $100 billion business. Azure is a $40 billion business. These are huge businesses, and they're seeing a big uptick in growth, and again, at very high margins. So, and then the productivity measures I referred to earlier, 25% uptick in productivity, either through anecdotes that you hear on company earnings conference calls or through a variety of different academic research. That's the return on that investment as well. And then there's and then there's little case studies that you hear about everywhere. With even a small restaurant company, a trucking company that's talking about their revenues seeing an uplift from implementing these tools. So I think it's going to be very hard to aggregate at the economic level the productivity in the sense that an economist would be comfortable saying broadly in real time we're seeing a productivity lift from this spend. Rob would know more about this than I do, but that type of calculation normally has a lot of errors, and there's a lot of hypothesis that goes into that, but also it's often not clear until years after you actually experience the return. So I think I can't give you an answer that is rock solid, like there's the return, but I can tell you just by looking at these different data points that I feel confident that there is a return being earned. And I think the biggest one is the one Rob referred to, is that you've got these incredibly profitable, incredibly smart people that run some of the greatest companies in the history of mankind are increasing the amount they're spending because they see the possibility of returns now and in the future.
What about some of the smaller companies? And I'll ask, I guess, on both sides of the house, but stick with the equities for a second here. You're talking about some of the major
Yep.
publicly traded companies out there. What about, you see companies that are
Yeah.
venture? How's it going?
I'll give you I'll give you an anecdote of a small company. It's Wingstop. Okay, Wingstop, which is the chicken joint place.
I thought so.
Yes.
Made me hungry.
So they have used a prediction model using generative AI tools to roll out what they call their smart kitchen. And what that is doing is it's drawing from, of course, their prior results of when, and what they're trying to do is predict demand so that their kitchen is staffed appropriately. And so they use a whole bunch of different inputs, including their prior results, weather. They even pull in information from like prediction markets and like DraftKings to know when there's a lot of action on games. And the entire reason they're doing this is so that when Andy D'Souza calls for chicken wings or looks on DoorDash for chicken wings, that from Wingstop, it's coming to you in 13 minutes instead of 21 minutes. And so because they know if you see 13 minutes instead of 21 minutes, you're more likely to order, and they can turn the kitchen over faster. And that's real revenue and a real return that they're getting. So that's just one very silly but real life example of the types of things we're hearing from companies and the way they're using these tools and how they're seeing an immediate either uplift in productivity or revenues.
I do like wings, and I am very impatient, so that one hits home for sure.
Perfect for you.
It's great for me. Rob, how about you like wings, Rob?
I do like wings. It's bad for you, bad for my diet.
Are you impatient by nature?
A little bit.
Okay.
Occupational hazard.
We'll get some wings after this.
Sounds great. Okay, so I'm going to give the disruption side. But before I do that, let me say, as far as I can tell, as you might be able to tell from some of my earlier comments, I'm a true believer in the potential for AI to change the world in a very positive way.
Mm-hmm.
Productivity is hard to measure, maybe extremely hard to measure with accuracy in the short run, as Matt said. We have trained economists on our team. They would confirm that. But what I see is massive potential. I'm a true believer, at the very least in the potential and more broadly speaking. That being said, I'm going to give you the potential disruption side. So the disruption side is if AI keeps, if the scaling laws, and we can define that later, continue to work. It's not an actual law, but effectively the innovation, the power of AI continues to work and accelerate even. The future could be extremely bright. Higher productivity is good for society. Let's separate out the distribution of that because that matters. It matters a lot, but let's separate it for a second. It means you can produce more with the same number of people or even fewer people, workers. GDP will grow. Inflation might be more contained. This is a very benign and positive scenario for humankind. It's very exciting for our kids. But I'll still give you the negative side because I'm a bond guy. Okay? So the negative side is many industries get disrupted. What has happened over the last few weeks or even months has been massive rotations below the surface. That's probably not going to surprise anyone who's watching or listening, but the massive bear markets, fear, potential for disruption is there. One shouldn't make light of it. I'll point to probably the most obvious sector and the one maybe most vulnerable, probably most vulnerable, is software in general. Software has been eating the world for a decade and a half. So you can go reread the Mark Andreessen, the famed, venture capitalist. I think he wrote the paper in 2000 or the article in 2011. Software is eating the world. That happened for a decade plus. And some of the most valuable companies in the world, these software companies or SaaS, so-called SaaS companies, related, huge wealth creation. Very large companies, and you can name all of them. I can name probably 70% of them. If software ate the world for so long, there's a chance that AI eats software. If everybody can vibe code and with such a powerful AI model, if a novice who can't code in Python or anything else like me could go into the powerfully enough AI and say, build me, I have an idea to solve some problem for someone, write the code. I don't need to know. I mean, it could be glitchy, but it's going to get increasingly better and better. And it's already writing a tremendous amount of code. I can create some app that makes a lot of money if I do it right. Again, there's massive competition. Maybe somebody else would do it better because they know how to prompt better. But that's the potential disruption we are looking for if you are a software company. The reason software was such a good business, as to take a step back, was you put in the original R&D, you have these great software engineers and people can write code. They build something great, it solves a problem, and then you sell it and you scale really fast.
Yes.
And then it's all gravy from there because you can replicate essentially costless because you have the intellectual property. I mean, their network effects, their relationships, their sales, their partnerships, there are a lot of moats potentially, but you've built a great business. Now, there is a possibility AI, because it is so powerful, can write all that code so quickly because it works 24/7, and all the massive compute that Matt talked about, which is only increasing. Compute just means you're getting a whole lot of super powerful chips from NVIDIA and AMD and Broadcom and whoever else. You buy enough of it and you throw enough data, this is the scaling laws, magic comes out. It can be so powerful. A novice, an amateur, someone who can't code could build something that is potentially disruptive to lots of software businesses. Last thing I'd say here, and I can go on, is one needs to separate which software companies have enough of those moats, frictions, true advantages, real things that make them sticky and hard to disrupt, versus perhaps, probably, maybe some of the smaller, less profitable, lower cash flow, earlier stage businesses that you can't paint with a broad brush, fewer resources, less cash on hand. They're scaling right now. Those might be more vulnerable than the biggest, software companies out there.
And when you guys look at companies, whether it's the equity side of the house or the debt side, when you think about some metrics like annual recurring revenue, which was seen as sort of rock solid and almost like a constant into the future, suddenly that's being sort of like shaken a bit. Has your philosophy process changed at all these types of companies? How do you think about them, and is it any different than you were before?
So no change in our philosophy or process, but I think you have to stress test your assumptions on these companies. And what we've done is lean into a bit more of the qualitative elements of our process.
What do you mean?
So I can tell you what a company's net revenue retention is today, or I could tell you what their ARR is today. I could tell you what their margins are today. But what's at debate is what are those numbers going to be 3 years and 5 years from now? So I'm spending a lot more time evaluating the management team of the companies we're investing in. It's a good time to be invested in companies that are still led by what I'll call maniacal founders.
Humans.
Yeah. Well, yeah, humans for one, yes.
For now.
But a special kind of human, someone who has started the company from the ground up, have used the company as their child, and will do anything to make sure that that child grows up and is
Yeah.
bigger and stronger in the future. And that doesn't mean you have to be a founder to have that point of view, but we're looking at our management teams and saying, do they have the that raw ability, that raw potential to do what it takes to operate in this wildly disruptive world? We're then looking at, Rob used the term moats, the competitive advantage of these companies. How sustainable are they? Not just what they have today, but how sustainable is in the future. And a lot of that comes back to the management team and the culture of the company. Do they have a culture of innovation, a culture of disruption? Are they willing to disrupt themselves? Are they willing to take new revenues on at 65% gross margins when the old business was at 85% gross margins? Because in the future, if they don't, they won't have a business at the same size or scale. So, and then I also think the last thing is, I talked a little bit about, the platform shift and the latest shift towards this agentic world. We're asking ourselves, how do these, especially in software specifically, how do these companies exist in this agentic world, whether it's agentic commerce or agentic software. And by agentic, we just mean imagine a, a group of agents that are executing tasks on your behalf. And so, do you have a company that is positioned well for that future? So and you could go through every software company and you can again look at their financials. Their financial strength is certainly important for where they are and how well they can weather the storm. But they're willing to navigate through change. What I'm laying out for you, these qualitative elements
Mhm.
are our view on their ability to navigate incredible disruption and change that we think can make them successful again 3 or 5 years from now. Because to Rob's point, this is where there has been the most the largest drawdown in share prices has been in software or in these areas where Gen AI is disrupting. And the baby, so to speak, has been thrown out with the bathwater. And so if you have a bunch of companies that are trading at a much lower price than they were before, there are some that will not be here in 3 years. There are some that will have a very different, worse business model in 3 to 5 years. And so what we're spending a lot of time on is trying to pick through the wreckage, so to speak, and figure out which of these companies have what it takes to not just be on the other side, but be stronger on the other side.
Yeah, it's interesting you talk about the advances in productivity through technology, yet at the same time you're spending almost more time now on the qualitative factors in terms of the humans involved, which is interesting.
Well, we could also use some Gen AI tools internally to scrape through hundreds and hundreds of earnings reports to get a sense of earnings calls, to get a sense of which companies are doing this better than others. So we are using some AI tools to enhance our research, the pace of our research.
Combination.
Yeah.
Gotcha. Rob.
Yeah. Okay. So let me say a few things that I think are related to your question and the discussion. The first is this is an exciting time for active managers. When you have this much potential disruption, both with the conflict plus AI and other things we can talk about, like credit crunch and cockroaches. This is where active management can shine. Deep credit research, separating out what is unfairly beaten up versus what is more resilient or more protected or more remote from the AI disruption, to use that topic. This is where the hard work is done by our teams, right? So it's a very exciting time if we have the right people and we make the right calls. Very exciting time for active managers. That's the first thing I'd say. The second thing I'd say is a response to your question. Yeah, 50% ARR, 75% ARR, 100% ARR. That's all backward looking. I mean, so are earnings, but besides guidance. Yeah, that's the risk. Is AI disrupts you, you can go from the 100 ARR or 50% ARR to like negative and game over and out of business, depending. I'm not saying it's going to happen to everyone.
Yeah.
ARR is a concept that is more, it could apply to anything, but it tends to be more early stage often because established large, I'll use investment grade public companies, there's a long history there. There's a lot of scrutiny of them. It doesn't mean they aren't somewhat vulnerable. No one's completely protected, but that's the key, right? Make no mistake about what we're talking about. Yeah, 50 AR, 75 AR sounds great. And the reason they are is revenue is because sometimes you don't have the earnings yet. And that's okay. Amazon did that for a long time and they did all right for themselves. The real risk is now you never make it to that point, right? So that's where the deep research and the active management are critical. The last thing I'd add here on the bond side is, and I'll talk specifically for the public bond markets, that's both investment grade and leverage graded high yield, leverage loans. The issue here is, and I'll start with investment grade corporates. If credit spreads are pretty tight. There's usually a pretty big negative asymmetry, especially when credit spreads are tight, to bonds. If the revenue keeps going and the cash flow keeps going, you might tighten, you might outperform maturity or duration treasuries, which is a good thing, plus the extra income and coupon. But if you're wrong, at the extreme, it could be really bad. You have true value destruction, downgrade, default, falling to below investment grade territory. Those are all bad things for a bond holder if you're overweight or if you hold those bonds. If it's trading on spread, especially really tight spreads, you don't have the upside of getting it right necessarily. With the uncertainty around AI and what will happen next, although I'm a true believer, I'll repeat, sometimes you're not getting paid. You don't have to be there. It's a little less true or maybe meaningfully less true on below investment grade side, including some of the stuff that's gotten beaten up. So in the broadly syndicated leveraged loan market, depending on what index or what data you use, it's about 13% in software. If you define it more broadly, it's a lot bigger than that, but 13% in software. Those loans, software loans, many of them took a pretty big hit. They've already bounced some in recent days, took a pretty big hit. And back to my earlier comment, we are doing the work. We find some interesting things to buy there. And you're not buying them at par anymore. You might buy them at $90 price or $80 price or something different, but you have more upside plus all the coupon and the carry. So exciting times for active managers. You better be able to do the work. And that's what they pay us for.
I love it. Thanks, guys, for the time today. Really appreciate it.
Thanks for having me here. Yeah.
Thank you for listening to The Investment Conversation. Find more episodes wherever you get your podcasts or at lordabbott.com. And follow us on LinkedIn, Instagram, and YouTube for more perspectives from across the firm.